For years, Lululemon was valued as a high-growth retail leader. Today, that market premium has evaporated, with shares trading near $118. This chart maps Lululemon's North American sales. A downward slope marks 5 consecutive quarters of declining domestic revenue. Simultaneously, profitability is squeezed. Surging U.S. tariffs and heavy markdowns to clear inventory have stripped 400 basis points from their gross margin. Market share is also under pressure. Specialized competitors like Alo and Vori are successfully capturing younger demographics that previously prioritized the Lululemon brand. Internally, a multi-month executive search following a CEO departure created friction, slowing the development pipeline and leading to a string of uninspired product launches. With growth stalling and margins contracting, the prevailing market sentiment suggests the brand has reached a state of permanent domestic saturation. But while the broader market sells, a specific group of disciplined, value-oriented super investors is doing the opposite. Michael Burry, the investor who correctly identified the subprime mortgage collapse, just purchased 100,000 shares amid this specific price decline. Other value heavyweights, like Phil Town, have also quietly accumulated tens of thousands of shares, building Lululemon into a core portfolio position. These investors typically look for predictable, cash-generating businesses with defensible economic moats. A retailer facing declining sales and rising competition rarely meets those criteria. To understand why this smart capital is moving, we have to look past the stock chart and audit the underlying mechanics of the business. This diagram compares a traditional wholesale model against Lululemon's vertical control. Because they sell almost exclusively through their own stores and apps, they keep the full retail margin and prevent their products from being discounted in third-party environments. That pricing power is rooted in proprietary technical fabrics like Luon and Nulu. While competitors can mimic the look, the specific tactile performance of these materials is protected intellectual property. They also bypass expensive celebrity endorsements, instead utilizing local fitness leaders to build brand loyalty through community-level advocacy. While tariff and inventory costs are heavy, unit inventory is actually down 4% year-over-year. This shows their markdown strategy is effectively clearing the glut, suggesting the pressure is a temporary management hurdle rather than a structural failure. Furthermore, the domestic slowdown is countered by a massive 30% revenue expansion in mainland China, which now accounts for 16% of total business. The external environment is difficult, but Lululemon's internal economic engine remains functional and highly efficient. Let's run Lululemon's raw financials through a strict value investing checklist to measure its fundamental financial health. Starting with the balance sheet. Lululemon holds exactly $0 in long-term bank debt and over $1.5 billion in cash. Furthermore, the company has delivered positive free cash flow for 10 consecutive years and maintains a 10-year average return on equity over 30%. Evaluated purely on these audit metrics, Lululemon remains a high-performing compounding machine, regardless of the current market sentiment. This graph tracks Lululemon's valuation multiple over the last decade. The current sell-off has compressed their price-to-earnings ratio from a historical average of 42 down to 9.5 times trailing earnings. To find the fundamental floor for this asset, we use a discounted cash flow model, which calculates the value of the business today, even if it never grows another %. Based on trailing free cash flow, a conservative no-growth analysis places Lululemon's intrinsic value at $173.79 per share. With the stock trading near $118, investors are essentially securing a nearly 32% protective discount. This is the margin of safety. A potential catalyst for recovery arrives in September, when incoming CEO Heidi O'Neill takes over with a mandate to stabilize the domestic product pipeline and defend the brand's premium margins. Lululemon's low multiple valuation, combined with its high return on capital and zero debt, makes it a compelling candidate for patient, value-oriented investors willing to wait out the cycle. To run your own detailed valuation models, download the Buffett Indicator iOS app and join our investor community at deepvalues.ai. Please remember, this video is for educational purposes only and does not constitute financial advice.